Today, we're diving into the world of investing and focusing on one of the most well-known indices in the financial realm, the S&P 500. If you're wondering what the S&P 500 is and whether it's a smart choice for your investment portfolio, you're in the right place. By the end of this video, you'll have a clear understanding of what the S&P 500 is all about, and you'll be better equipped to make an informed decision about whether it's a good investment for you. Let's begin with the basics. The S&P 500, short for the Standard & Poor's 500, is a stock market index that measures the performance of 500 of the largest companies listed on stock exchanges in the United States. These companies represent a wide range of industries and sectors, making the S&P 500 a comprehensive gauge of the U.S. stock market's health and performance. The S&P 500 was introduced in 1957, and it has since become one of the most widely followed equity indices worldwide. In fact, it's often considered one of the best representations of the U.S. stock market as a whole. Investors, financial professionals, and the media use the S&P 500 as a benchmark to assess the stock market's overall performance.
The S&P 500 index fund is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion, and you're buying America. And
now that you know what the S&P 500 is, let's take a closer look at how it operates. The index is market capitalization weighted, which means that larger companies have a more significant influence on its movements. This makes it different from an equal weighted index, where all companies carry the same weight, regardless of their size. To calculate the value of the S&P 500, a formula is used that takes into account the total market capitalization of the index's constituents. In simple terms, if a company's stock price goes up, and it's one of the 500 companies in the index, it will have a positive impact on the S&P 500's value. Now, the big question, should you consider investing in the S&P 500? The answer, as always in the world of finance, depends on your financial goals, risk tolerance, and investment strategy. One of the primary advantages of investing in the S&P 500 is diversification. Since it encompasses 500 different companies, it spreads risk across various industries and sectors. This can help mitigate the impact of a poor-performing stock or industry on your overall portfolio. Over the long term, the S&P 500 has shown strong performance, historically averaging around a 7 to 10% annual return. Keep in mind that past performance doesn't guarantee future results, but it's an encouraging sign. The S&P 500 has weathered various economic conditions, and it often rebounds after market downturns. Many S&P 500 index funds and exchange-traded funds, or ETFs, offer low expense ratios, making it a cost-effective way to invest in a broad array of U.S. companies. These low expenses mean more of your investment dollars stay invested and have the potential to grow over time. The S&P 500 is incredibly liquid, meaning you can easily buy or sell assets within it, which is a significant advantage for investors who value flexibility. You can access your investment whenever you need to, without worrying about liquidity issues that can affect less traded securities. While the S&P 500 offers several benefits, it's crucial to be aware of the potential downsides and risks. Like any stock market investment, the S&P 500 can be subject to market volatility. It can experience periods of significant ups and downs, so you should be prepared for potential short-term losses. While the long-term trend has been positive, there can be periods of bear markets and corrections. There's no guarantee that the S&P 500 will continue to perform as it has historically. The stock market can be unpredictable, and economic events can impact its performance. External factors like global economic crises, political events, and shifts in monetary policy can influence the index's performance. When you invest in the S&P 500, You don't have direct control over the individual companies in the index. You're essentially along for the ride, whether a company performs well or not. If you're someone who prefers a more hands-on approach to investing and enjoys researching and choosing individual stocks, this aspect may not align with your investment style. Market timing can be challenging. You'll need to decide when to buy and sell, which can be a tricky endeavor even for experienced investors. Timing the market perfectly is notoriously difficult, and many investors adopt a long-term buy and hold strategy rather than trying to predict short-term market movements. If you decide that investing in the S&P 500 aligns with your financial goals, there are a few ways to go about it. You can invest in S&P 500 index funds, which are managed funds that aim to replicate the index's performance. These funds are often known for their low fees. They provide you with a diversified portfolio of S&P 500 companies and typically have lower expense ratios compared to actively managed funds. S&P 500 ETFs are similar to index funds, but are traded on stock exchanges like individual stocks. They offer liquidity and low costs, and you can buy and sell them throughout the trading day. ETFs have gained popularity for their flexibility and low expenses. If you prefer a more hands-on approach, you can buy shares of the 500 companies individually. However, this approach requires more research and management. It's essential to carefully consider each company's fundamentals and prospects before making individual stock investments. For many investors, the allure of the S&P 500 lies in its long-term growth potential. Historical data shows that despite the occasional market turbulence, the S&P 500 has been on an upward trajectory over extended periods. This is one reason why it's a cornerstone of many retirement portfolios. It's worth mentioning that the S&P 500 isn't confined to domestic investors. Thanks to exchange-traded funds and other investment vehicles, individuals from around the world can gain exposure to this iconic index. In doing so, they can participate in the American economy's performance and capitalize on the innovation and stability that the U.S. market is known for. In addition to its investment merits, the S&P 500 is a reliable economic barometer. When economists and financial experts want to gauge the overall health of the U.S. economy, they often turn to the S&P 500. Its performance reflects economic conditions, business confidence, and consumer sentiment. For investors, the S&P 500 serves as a powerful benchmark. When assessing the performance of their investment portfolios, they often compare their returns to those of the S&P 500. If your investments are consistently underperforming the index, it might be a signal to reevaluate your strategy or seek professional advice. Keep in mind that, like any investment, the S&P 500 isn't a one-size-fits-all solution. Your investment choices should align with your goals, risk tolerance, and time horizon. While the S&P 500 offers diversification, it's essential to diversify further by including a mix of asset classes in your portfolio. Consider bonds, international stocks, and other investments to reduce overall risk. A key principle in investing is not to put all your eggs in one basket. This means spreading your investments across various assets. Diversification can help reduce risk because different assets may not move in the same direction at the same time. Therefore, adding non-correlated investments to your portfolio can help manage risk. The S&P 500, with its U.S. focus, doesn't provide exposure to international markets. If you want international diversification, you'll need to look beyond this index. An advisor can help you build a well-balanced portfolio tailored to your needs. Investing in the S&P 500 can be a significant step toward financial security and wealth accumulation, but it should be part of a broader portfolio. Proper diversification, risk management, and a long-term perspective are essential components of a successful investment strategy. So, should you invest in the S&P 500? It can be a valuable addition to your portfolio, but always consider your specific financial objectives before making investment decisions. In conclusion, the S&P 500 is a renowned and widely respected index that represents the performance of 500 major U.S. companies. It offers diversification, historical performance, and low costs, making it an attractive investment option for many. However, it's not without risks, and its performance is subject to market volatility. Before investing in the S&P 500, carefully consider your financial goals and risk tolerance. It's always a good idea to consult with a financial advisor to ensure your investment choices align with your overall financial strategy. They can help you create an investment plan that considers your individual circumstances and long-term goals. Remember that investing in the stock market carries inherent risks, and the S&P 500 is just one of many investment options. The key to successful investing is thorough research, a well-thought-out strategy, and a long-term perspective. So, should you invest in the S&P 500? It may be a part of your investment strategy, but it's essential to make that decision within the context of your broader financial plan. Thank you for joining us today, and if you found this information helpful, don't forget to hit that like button and subscribe for more informative content on finance and investing. Until next time, happy investing!